Season 5, Episode 3, Liquidity, Control, and Time Commitment. So far this season, we've been looking at how capital behaves. In the last episode, we explored one of the most important distinctions in investing. Some assets primarily grow, some primarily produce income, and some do both. But behavior alone does not explain the full experience of owning an investment. Because every asset also carries a set of practical trade-offs that shape how the investment fits into a real life. And three of those trade-offs appear again and again across almost every investment we encounter: liquidity, control, and time commitment. These three forces quietly shape the investing landscape. Let's begin with liquidity. Liquidity simply refers to how easily an investment can be converted into cash. Some assets are extremely liquid. Public stocks, for example, can usually be bought or sold within seconds during market hours. Treasury bills are similarly liquid. In these markets, prices are constantly visible, and transactions happen quickly. Other assets are far less liquid. A piece of real estate may take weeks or months to sell. A privately owned business might require years to exit. Farmland, infrastructure assets, and private partnerships can all involve long time horizons before capital can be withdrawn. Liquidity has value because it creates flexibility. When capital is liquid, it can move quickly to new opportunities or respond to unexpected needs. But liquidity also comes with a trade-off. Highly liquid assets often provide less control. When you own shares in a public company, you are a minority owner. You cannot decide how the business operates. You cannot choose when profits are reinvested or distributed. You participate in the success of the enterprise, but you rarely control its direction. This is where the second dimension comes into play. Control. Some investments offer very little control. Others offer a great deal. If you own a rental property directly, you can decide how the property is managed, when renovations occur, how rents are set, and when the asset might be sold. If you own a private business, the level of control may be even greater. You influence strategy, operations, hiring, and capital allocation. Control can be valuable because it allows an investor to shape outcomes, but it also introduces something else: responsibility. And that leads to the third dimension: time commitment. Some investments require almost no ongoing attention. A diversified portfolio of publicly traded securities can operate quietly in the background for long periods of time. Other investments require far more involvement. Rental properties require maintenance, tenant relationships, and management decisions. Private businesses require strategy, operations, and leadership. Even some forms of private investing require regular oversight and monitoring. In these cases, the investment is not just capital. It is a combination of capital and effort. And that effort becomes part of the return. When we step back, an interesting pattern begins to emerge. Assets that are highly liquid often provide very little control and require very little time. Public equities and bonds tend to sit here. Assets that offer significant control often require more time and tend to be less liquid. Real estate and private businesses frequently fall into this category, and many investments land somewhere in between. These trade-offs are not flaws in the system. They are part of the design. Markets often reward investors who are willing to give up liquidity, contribute time, or accept responsibility. But those rewards come with corresponding commitments. Understanding this triangle, liquidity, control, and time, helps explain why different investors gravitate toward different kinds of assets. Someone who values flexibility and simplicity may prefer highly liquid investments that require little involvement. Another investor may prefer assets where they can influence outcomes directly, even if that means committing more time and accepting lower liquidity. Neither approach is inherently superior. They simply represent different ways of participating in the economic system. What matters is understanding the trade-offs. Because when investors misunderstand these forces, frustration often follows. Someone expecting passive income may end up with an investment that requires constant attention. Someone expecting flexibility may discover that their capital is tied up for years. But when the trade-offs are clear, the choices become easier to navigate. Liquidity, control, and time commitment are not separate from the behavior of capital. They are part of the behavior. Together, they shape how investments function inside a financial system. And once we understand these dimensions, we are ready to examine the first major environment where many investors encounter them: the world of public equities, ownership in businesses that operate across the global economy. And understanding how those businesses behave will help us take the next step in answering the central question of this season: where investment income actually comes from.